The broadcast is now starting. All attendees are in listen-only mode.
Well, good afternoon, everybody, and thank you for joining us today. We're delighted to have you for Plan Your Success, Top Corporate Considerations for Business Owners. Before we get started, just a couple of housekeeping items. Today's slides can be downloaded from the Handouts tab on your GoToWebinar dashboard. And we will also send you a copy of the slides and a link to the entire recorded session within a day or two of this session. We're going to make the webinar presentation available for only a limited time, so that's one thing to note. Just kind of due to market considerations, the fact that the market and our information is subject to change, I don't want to leave it up for an unlimited amount of time, but it will be available for several weeks. And again, we will distribute the slides to you. One final point, we do welcome questions. You can send them anytime during the course of the presentation. However, we probably will hold everything until the end. We expect the session will last 40 to 45 minutes, and then we'll have a few minutes for questions at the end. However, if your question is very specific to your business, we will probably most likely contact you personally at some point during the next few days. If you have a question of general application, we'll do our best to try to go ahead and answer it today. This next slide is just a disclaimer that we are attorneys, and the language here is to let you know that this session is for informational purposes only, and it doesn't constitute legal advice. My name is Mike Gennaro. I am a partner, and I am the head of the business and corporate practice here at PilieroMazza. My co-presenter is Livne, who is a corporate specialist here at the firm. We work in all manner of corporate transactions, including general corporate and mergers and acquisitions and general finance transactions. Our focus today is going to be more on mergers and acquisitions side of things. The point of top corporate considerations for business owners is mainly a reference to the fact that we'll be discussing how to get and keep your house in order and how to decide when to go ahead pursuing a strategic transaction. PilieroMazza is a full-service law firm located in Washington, D.C. Although we are best known for our government contracts practice, we also have a large and thriving corporate practice focused on mergers and acquisitions and finance transactions. We also have a litigation practice group and a labor and employment practice group, and we're equipped to handle basically any of your business needs that come up during your day-to-day operations. And we're happy to help or answer any questions about our other practice groups online, offline. So to start, I want to just sort of give everybody an overview of what our webinar is going to cover today. And this slide has to do with choosing the right team. When you're just starting out in a business transaction, it's very important to think ahead. One of the most important things that you're going to be doing is choosing a CPA and a counsel to advise you in your strategic transaction, whatever that may be. I also wanted to note that I noticed on our attendees list, we have a really robust list today consisting of really everybody from smaller entrepreneurs and smaller companies to very large established companies. So I just wanted to point out that this is really a 30,000 foot level overview of what you need to consider doing strategic transactions. Some of the information for some of you is going to be kind of elementary, but we're also going to discuss what the market is doing, and there are some really interesting developments that we want to get into in terms of the availability of bank financing that you may not know about. thinking more about what expertise you need on your team. I get a lot of calls from potential sellers and potential buyers who are just starting to think about doing a transaction. Many times there's this sense that, well, lawyers aren't necessarily needed, or an outside CPA is not needed. We're going to be talking today about the fact that you need a CPA to advise you, and you need a counsel to advise you that are really well versed in government contracts points, tax points, and other issues that come up if you were a government contractor specifically. You will find that choosing the right team allows you to get through the transaction much more quickly and much more efficiently than if you try to do everything in-house, or if you hire somebody who doesn't have particular specific government contracts experience. So let's talk a little bit about financing and legal issues that emerge at the very beginning of a deal. And again, as I was just discussing, retaining effective counsel is probably your first step when you're considering doing a transaction. If you are borrowing money, the bank will have its own counsel and it will have its own financing team. If you're a purchaser who's doing a leveraged transaction, that's fine, but a bank's underwriting process isn't necessarily going to look after your interests. The bank wants to be sure that you can repay any money that you borrow, but you need a counsel of your own to review the loan documents, to review the transaction documents themselves, and to act as your advocate with respect both to the other party and with respect to the bank. And by keeping your counsel involved at all times from the letter of intent stage forward, you're actually going to be saving on transaction expenses. If you are interested in doing a deal where you are borrowing money to make an acquisition, we're going to talk about in a little bit the fact that the lending environment has become very favorable, specifically for government contractors. So make sure you're comparing your lenders to assure that you receive economic and commercial terms that not only make sense for you, but are apples to apples when you compare the different deals you're getting from competing banks. By completing your own due diligence, you will more easily be able to compare lender offers, and Donna's going to talk a little bit later about the due diligence process and some hot button issues to look out for. Use an LOI is the general rule, okay? I want to make clear, though, that that a letter of intent isn't always your friend as a government contractor. There's something called the present effect rule, which, if you're a government contractor, is something you're going to potentially have to look out for. And this is another instance where retaining a counsel who's knowledgeable when not to use an LOI is really critical to your deal. But generally speaking, a letter of intent is the most effective way you're going to be able to avoid unnecessary deal expenses before you incurred them. The LOI itself sets out all of the major deal terms, including pricing, including any contingent pricing such as earnouts, the major indemnification terms, and various other terms that would otherwise have to be negotiated in the context of the transaction agreement. By setting out all of these deal points in a 3 to 5 page LOI, you are generally going to avoid a lot of unnecessary back and forth that you would otherwise have to deal with when you are getting into the definitive purchase documentation. So you just want to make sure when you're negotiating the LOI that it generally not a binding agreement, that you can have some non-binding terms like an exclusivity provision which prevents your target from talking to other potential suitors, but you want generally to include things like a price range, in more general terms for what specifically the earnout is going to look like if there is an earnout. And again, that's something that your counsel can lead you through and give you a great deal of confidence in looking forward. And finally on here I have know yourself, and what I mean by that is take all the steps you can, whether you are a seller or a purchaser, to know your company in order to avoid any deal-killing surprises. A lot of details can be dealt with easily, I say during the LOI stage, but also pre-LOI, pre-transaction, especially if you're a seller. Keep in mind that when you are doing a deal that involves the transfer of government contracts, it's very, very important that those contracts get transferred with a minimum of hassle, since they typically present sort of the heart of the economic terms of the deal. So, knowing what contracts can be transferred and what transfer restrictions might exist are also critical, and it's critical to identify those restrictions before you actually identify an appropriate potential partner.
All right, good afternoon, everyone. Building on the prior slide, I'll talk a little bit about the structure of the deal and the options that you have. If approached properly, selling your business will rank among the most significant and rewarding moves of your career. It's really the culmination of your years of patience, hard work, and vision. Once you've decided to purchase a company, sell your company, or merge with a company, what are your strategies? One option, the first one that I'll discuss, is the asset purchase route, where the entire portion of the assets involved in performing the work is sold. For example, all of your government contracts or your equipment, or perhaps your facilities. This would involve selling all of these assets that are owned by your company. You sell your factory, you sell your contracts to a buyer. The second route we have here is the stock purchase route. When a buyer purchases all of your company's stock, the corporation continues to exist with assets and liabilities, but with new stockholders, the buyer. Generally, a novation agreement is not required if there is a change in ownership as a result of stock purchase, and Mike will mention that again later. Now, we get a lot of questions about, what is a merger? Most mergers unite two existing companies into one new company, while an acquisition, whether an asset or stock purchase, is the purchase of one company by another in which no new company is formed. The second bullet I have here is about joint venture agreements. A lot of our work here at the firm involves helping companies that want to remain independent but want to combine forces for a particular purpose. A joint venture agreement will help you do that. In the commercial world, this is somewhat easier than in the government contracts world. In the commercial world, you can join together with another company, work on a particular project, and the JV means you can limit the liabilities that flow from your work together on that particular project. However, in the government contracting world, which is regulated by the SBA, joint ventures are more complicated. They're regulated by the SBA and must comply with SBA regulations. Also, you and your joint venture partner will set up a new entity where one of the companies, usually the SBA program concern, is the majority holder.
And in talking about joint ventures and mentor-protege agreements, I just want to add that JV agreements, mentor-protege agreements, these are structures with which our clients have been very successful over the years, and they will always have some utility. But I also wanted to point out that there are some very attractive options available now in terms of borrowing money to consummate an acquisition. And if you are interested in looking at the JV route or the mentor-protege route, you should be aware that the the SBA's 7A loan program is really coming back into vogue. And there are many reasons for that. You know, when you get a new administration come into the White House, you have a lot of talented people leave also, and some people, everybody I think is aware of the fact that new administrations tend to change policy, but fewer people are aware that when the old administration leaves, you've got an extremely talented group that has their own views of how the Small Business Administration should run based on years of experience. And one such person, we're very fortunate, joined us and formed PilieroMazza Advisory Services, which is an affiliate of ours now. John Shiraka is the former Associate Administrator of Government Contracts and Business Development for the SBA. He is an excellent resource for you if you're considering a strategic transaction, if you're considering a joint venture, if you're considering mentor-protege. And the other point I wanted to make is that, you know, if you think you're on the market you're going to be on the market for doing an acquisition several years from now, but you feel like, well, I don't really have the available capital resources to do it today, just wanted to make you aware that that 7A loan program permits you to do all sorts of... So getting back to the 7A loan program, I was just making the point that the program itself allows you to make a significant acquisition with very, very little upfront capital commitment. So that's something that if you are considering any type of strategic transaction within the next few years, maybe you want to move that timetable up, and that's something that we can discuss with you, and that also John Shiraka at Advisory Services can help you out with. So the next slide is stages of a strategic transaction. And again, I think that the primary question you have to ask are, what are your short-term goals and what are your long-term goals? Do you expect your company to be able to grow organically and meet your growth and revenue goals that way? Or are you interested in expanding through acquiring another company? It is becoming easier to acquire other companies. We're seeing, in terms of market trends, we're seeing through first quarter of 2017, the M&A market generally, and especially in the small business world, we're seeing multiples pick up. On the consulting side, for a couple of years, we were looking at multiples of around between 3 and 5. We're seeing now that the higher end of the multiple is getting up closer to the 6.5 range, which is really good news, generally speaking. The lending environment, although interest rates are going up, the lenders are generally much more favorable to various loan programs that will allow purchasers of businesses to borrow money for transactions. And as I stated before, that 7A loan program is coming back into favor.
All right, so what are some recommended strategies for buyers and sellers? Here we have 3 guiding words for the successful transaction. The first one is really transparency. There should be no surprises. You don't want to surprise the other party, and you don't want to be surprised by the other party. One way to do that, which we will talk about, is through a thorough due diligence process. Second is credibility. If you change your position throughout the process, and it can be a long process, justify it. The third word we have here is reasonableness. Articulate your good reason and logic to support your positions. Communicate with the other side in a coherent way. Success is in the planning. Who are your trusted advisors, both internally and externally? Spend some time assembling your A-team. If you're in the SBA world, just like Mike said earlier, are they experienced in that sector? Okay, now we'll talk about the steps. Here the slide is chronology, sequence of steps in an M&A transaction. The first point I have here is a confidentiality agreement. So now you've decided on the type of transaction and you're thinking about the company that you want to deal with. You think you either want to sell or buy. What's next? If you start with a confidentiality agreement, that can be very helpful. In the process of the transaction, you and the other company will want to share a lot of confidential information. This agreement is designed to ensure that the information stays between you and that company. Here you will want to think about the scope of the confidential information, and it may vary depending on your industry. For example, do you have a lot of intellectual property that you want to protect? Do you have a secret recipe? You also want to think about the length of time that this agreement will be in place for. The second point I have here is the letter of intent, which we've discussed a little bit earlier. Sometimes you may want to include a confidentiality provision in the letter of intent itself. The LOI is generally drafted to be non-binding, meaning that parties accept that other than some material terms, they may come to agree to deviate from the terms of the LOI. You may also want to have a binding exclusivity provision to make sure that the other company is committed to you specifically and not negotiating with other companies. The LOI may cover price, due diligence process, which we'll discuss later, financing, and other terms.
And I just want to make one point, because this comes up sometimes, especially with clients who are working on their first strategic transaction. It's fairly standard practice to have multiple confidentiality agreements with multiple parties in place. Obviously, once you reach the LOI stage, that's not the case. You want the LOI to reflect one agreement with one party, who's obviously the one that you selected based on your discussions and the pre-due diligence process. But when you're just starting off, you're looking for suitors, very, very common to have several confidentiality agreements in place.
Right, and what are the implications for government contractors specifically? We touched upon this a little bit earlier in the presentation. One wrinkle is that companies that participate in the Small Business Administration programs should be aware of is the present effect rule. The SBA has taken the view that agreements to merge, including agreements in principle, may have a present effect on the power to control the company. The SBA may treat such agreements as though the rights granted have been exercised, which could have serious consequences for set-aside concerns. This may trigger change of control provisions and affiliation principles.
And I just wanted to answer one question pretty quickly. We have a question: where do we find the handout tab to download and print the presentation? And it's in the Go to Webinar panel under Handouts.
On mobile, it is on the handout tab. All right. The next slide, we will talk a little bit about due diligence here. Due diligence involves a thorough analysis of your business that will generally identify not only the assets and liabilities, but the hidden gems, that secret recipe, and those traps that could intrigue and challenge potential buyers. Although every sale is different, all will involve at least some form of due diligence. At a minimum, a buyer will conduct its own due diligence review in connection with its purchase. Seller-side due diligence, generally completed prior to the marketing phase, in anticipation of the buyer's investigation, can ensure that potential buyers appreciate your business's true value, while identifying and mitigating business risks. For example, lawyers will analyze the contracts of your company, obligations, and liabilities. The next point I have here is the definitive agreement. Once you've decided on the type of deal, the definitive agreement will be drafted by your lawyer. There may be a lot of back and forth between your lawyers and the other company's lawyers. That can take a long time. It's very important to know that whatever is in the agreement is it. Now, signing of the definitive agreement. Once that process is complete, you will sign the agreement. That may not be very ceremonial. It may just be an electronic exchange of signature pages. However, there's still more to do, and sometimes clients are surprised by this, that there's no handshake necessary for exchanging of the signature pages. Okay, the closing conditions. There may be some conditions that have to be satisfied before the closing can actually occur. They can be securing financing, obtaining consents from third parties, issues like that. They can take some time. And then, finally, once those conditions are fulfilled, the parties generally tend to consummate the deal. The money promised, which could have been sitting in an escrow account, is usually now transferred, and stock certificates or assets are exchanged. And then it's done. You can go celebrate. But don't forget, number 8, the post-closing performance. A very important step is that will help ensure the success of the business you've just bought is what we call the post-closing performance. You've purchased a live business. It needs to continue to run. You may need the cooperation of the other party to take certain steps. Now the work really begins. All of those steps of the chronology should be carefully planned out at the outset. Yes, there will be some unknowns, some surprises, and some areas that will need further thinking when you're already in the process. But many aspects of the deal can be thought through in advance, and a strategy can be developed for handling the known and the unknown. Things the seller should do prior to sale. As seller, plan ahead. Generally, it is the buyer that conducts the due diligence, as I mentioned, of what the seller is selling. But if you're selling, think about conducting your own due diligence. This will save time later when the buyer requests explanation to questions, and will put you in a stronger position to address any issues, or at least be ready to explain them as the buyer gets to know your business better. Second, manage expectations. Get a second or third opinion. What is the right price? Why? How will you justify it? As a seller, you may be ready to sell and move on. However, this process takes time. There are steps that should be taken, and they take a lot of time. Therefore, commit to the process. Sometimes people say that business owners have 2 full-time jobs. We know it's even more than that. It's hard work, but it's rewarding. Okay. On to the next slide. I'm on slide number 16. Things a buyer should do prior to an acquisition. As a buyer, know your strengths and weaknesses. Know what you want to buy and why you want to buy it. The execution should be based on a defined corporate strategy, using that A-team that we mentioned earlier. Make the commitment. You have to be all in. Commit the necessary time and resources. With yourself, your team, that means your lawyer too. Think about what it is that you want. This process will take time and resources. Success here depends on your willingness to commit to the process. Okay, so I will end here by saying that sellers and buyers should always enter a negotiation armed with as much information as possible. And that may mean understanding what a buyer is likely to pay and how much a company is worth, among other issues.
And I wanted to include just a quick word about choice of law and why it's important. You know, many of our clients are located in the Dakotas and Montana and Alaska and other smaller states. And it's important, I think, to bring up that when you're doing a strategic transaction, one thing that really works in your favor is having predictability of law. Just because you're in North Dakota doesn't mean you have to use North Dakota law as the governing law for your transaction. In fact, we'd advise against it. We typically try to steer clients toward using Delaware law or New York, California, or even Maryland or Virginia law as governing law for their transaction documents. The reason you want to do this really is twofold. First of all, it increases the marketability of your company after the transaction is over. If you're thinking in terms of bringing on potential third-party investors someday, third-party investors look toward documents that are drafted with the idea in mind that they will need as little updating as possible. And as an investor, I think often the last thing you want to do is to be in the position where you're going to have to hire local counsel in North Dakota to help you interpret some provision of law that comes up in the transaction agreements. Also, if you choose, say, Delaware law, Delaware has many, many court cases over the years that interpret both statutory law and various aspects of case law. So it creates a predictability of outcome. If you ever do have to litigate part of a deal, you will be able to do so in a venue that has a very well-established body of law for you, and you will be able to figure out more easily what the outcome of any dispute is going to be before the dispute happens. And a quick word also about novation, which is really a kind of a subject among itself. And I won't get too into the weeds about it, but I wanted to point out that in general, obviously a purchase of stock or membership interests is not going to require novation. So, you know, typically whether you're a seller or a buyer, that's something to really keep in mind, is the fact that if you purchase a company and make it your fully owned subsidiary, you will most likely not have to novate the contracts, because there is no real transfer of those contracts. If it's an asset purchase, however, well, all bets are off, and in that case you will have to submit a novation package. Typically the way that we structure these is in the definitive asset purchase agreement. We will make novation a condition subsequent to the transaction. Now what that means is, if novation is ultimately not approved, there will be either an unwinding or rescission of the transaction itself, or a reduction in the purchase price that's usually a material reduction. In this market, we're seeing more recessions than we are reductions in purchase price, but you do see both. So obviously, just from a corporate perspective and from a strategic perspective, novation is something that is not going to be desirable in terms of certainty of closing. If certainty of closing is very important to you, as it is most people entering into a transaction like this, then you're going to want to find a way around, if you can, asset purchase. And this is not to sound like a broken record. This is another reason why you need the right team working with you. Because in the ordinary commercial market, typically mergers and acquisitions are driven mostly by strategic business reasons and by tax reasons. However, in the government contract space, the structure you choose, whether it's a merger, an asset purchase, or a purchase of stock or membership interests, is going to be influenced greatly by the federal acquisition regulations. So you're going to have a sense of what options are available to you. Can you do an asset purchase? Can you do a purchase of membership interest? You know, it depends on what kind of business you own, what set-aside program you're participating in, as well as all the usual factors you have to think of, such as tax considerations. So just wanted to insert that into the equation for you to give some thought to. So that's the end of our presentation. I do want to take a couple of these questions, though, that have come in. We're getting quite a few, and I think I want to answer the ones that are the most general. And then if we do not get to your question for whatever reason, we can talk about it offline. We're happy to do that. The first question concerns the multiples that I mentioned at the beginning and whether I was talking about multiples of revenue or multiples of EBITDA. I'm talking about multiples of EBITDA, how it really seemed that for the past couple of years it's been pretty flat, at least on the GovCon consulting side, between 3 and 5 times EBITDA. But I've seen several deals lately that are approaching 6 or even 7. Since we're on the subject of multiples here, I want to point out that multiples are a really kind of handy way of doing a shorthand valuation of your business. However, I'd be very wary about using them as a direct negotiation tool. I wrote a blog recently on various valuation techniques, and it's available online, and I recommend that you take a look at that. Because typically speaking, multiple of revenue is great when you're negotiating initially and talking about a back of the napkin valuation, but you are going to want ultimately to retain a CPA to do a discounted cash flow analysis and really get into the heart of what your company is worth. Okay, what is the main difference between asset purchase and stock purchase? Well, as Dana said, an asset purchase is where you sort of cherry pick a company's assets. Usually those assets in the GovCon space consist of government contracts. Mm-hmm. And so what you do is you purchase the assets, and you do that as a way of avoiding taking on too much liability or taking on unwanted liabilities. If a company has significant debt, or if they have other variables that pose potential liabilities and you don't want to deal with those as a buyer, that's when you would try to effect an asset purchase. With the caveat that if you are doing an asset purchase to acquire government contracts, you are going to have to do a novation of those contracts, which adds a good deal of uncertainty to the potential transaction. A stock purchase, on the other hand, or a purchase of membership interests, if we're talking about an LLC, is where you acquire all of the issued and outstanding stock of a company or of an LLC if we're talking membership interests. When you do that, you are taking on all of the assets, all of the liabilities, you're taking on all of the risks associated with that company. So it is definitely a riskier proposition than an asset purchase, but it gives you much greater certainty of closing, and you do not need a novation if you do a stock purchase, generally speaking. So that's the biggest advantage. Okay, there's a question here about the threshold at which the SEC or FTC needs to approve the sale. Yeah, what you're talking about is there is a threshold for M&A deals, and it's the FTC and it's the Department of Justice who set limits, and I am a little reluctant to say that on the air because I haven't looked up the limit. It's around $72 million, and that goes up every January 1st. So I believe we're right around 72 million right now, but again, don't quote me on that. If you're doing a transaction in that range, let's talk about it so I can look up the actual number. Let's see. Okay, can you briefly at some point discuss indication of intent versus letter of intent with benefits and trade-offs of each? Really, these are synonymous. Indication of intent, letter of intent, memorandum of understanding. These are all basically synonyms for deals. When we're trying to make a deal seem like less of a binding agreement, we might call it indication of intent because that seems somehow a little less definitive. But quite honestly, it's all in the drafting. It's not in the title. And if you're considering entering into any sort of preliminary letter for a transaction, that's something that we should talk about, because sometimes non-binding doesn't mean non-binding in the eyes of the SBA.
We're getting a lot of questions, so we're just reading through them right now.
Yeah, and some of these are very kind of transaction specific, and I would have to have more information to give you a really clear answer. So we're trying to focus on questions right now that are the easiest to answer. Okay, here's an interesting one. How difficult is it to transfer state and federal contracts with the merger of two SDVOSB firms? That's really interesting because I just did a merger of two SDVOSB firms. There are various structural challenges for which there is very good case law available. And unfortunately, your district office has a lot of control over the expediency of the approval process. So in terms of how difficult it is, well, to be continued, because the merger has closed and we're still waiting for final approval of transfer of some of the contracts. We tend to treat contracts when we merge SDVOSB firms as a name change, and that strategy is very well supported, as I said, under current case law. So if I had to give you a ballpark number, I would say it would take probably between 3 and 6 months post-closing to get all of your contracts successfully transferred over and approved. However, the risk of this transaction is much less than I would have indicated to you 6 months ago, because this is something that happens, and as long as you structure it as a merger for reasons I won't get into now, because this is a pretty specific question. but you know, when that happens, there is good case law supporting it, and so it's something that if you want to do, you can enter into a merger with full confidence that you'll be able to eventually pull it off. Okay, what services for M&A do you offer, and how do you charge? Do you market and sell the business too? No, we handle only the legal end. In terms of marketing and business development, PilieroMazza Advisory Services would be a good place to start for that. We also have a number of business partners who do that type of work. We have experts that we can recommend in pretty much all price ranges, pretty helpfully, and we have experts we can recommend who have done a lot of government contracts work in the past as well. So we handle all of the legal side, from LOI to due diligence to drafting documents to getting the deal closed. We're often asked about pricing for legal fees, and the truth is it really varies widely. The two primary drivers toward pricing a deal are, number one, the amount of due diligence that we're going to have to sift through. In other words, are there 2 government contracts or are there 250 contracts? That's a really big driver in terms of what you're going to be spending on frontline due diligence. The second very important driver of your legal fees is how much negotiation, how much back and forth there is in negotiating the actual transaction documents. And this may or may not surprise you, but if you have sophisticated counsel on both sides, that tends to really help rather than hinder the negotiation process. I've had personally some stories where the other side was either not represented by counsel, or they were represented by, say, a family member who was an insurance attorney or something like that. And those negotiations are typically the most extended and the most drawn out and the most expensive. So typically, sophisticated parties will give you the most bang for your buck. Getting back to the original question, though, which is how much does it all cost? For a deal with fairly minimal due diligence and fairly minimal back and forth, where all we have to do is draft a basic set of transaction documents and the parties are in agreement about most everything, we've done deals for as low as $30,000 or $40,000 total. On the other hand, deals that are more complicated, deals with a lot of contracts review, or where there is a lot of back and forth in terms of negotiating terms of the documents, those prices can go up to as high as, I would say, about $160. I haven't done one in years that's been more than $160. I think if I had to choose an average price, it's probably around $100,000, but I think that has more to do with the type of businesses we tend to represent than anything else. I think that in terms of if you're concerned about the payment that's going to be required up front, I would say don't be too concerned about that. We can talk about how to structure the payments so that they're not hitting you necessarily every month when you're trying to close a deal and you need to keep your capital freed up to actually close the deal first. So I would say that's what the price range is, but in terms of how it's paid and when it's paid, that's all fairly negotiable.
I would like to add that we have great groups within the firm because sometimes in a deal you'll find that you need to, some employment issues come up, or some some corporate issues, but also very sophisticated government contracting issues. And so working together in the firm can also lower costs because we kind of assemble together a great team that can, whatever issues may arise, we've, probably done something like that in the past.
Right, and seeing something before is often 90% of the battle because we already know what direction to take it without a lot of internal consultation, and I know that tends to frustrate clients sometimes is too many charges for lawyers talking to one another. But we've got things down in terms of these transactions so that we work very efficiently. I see someone has actually given us a little bit more detail. How much would it cost for a 25 million sale price and 30 active contracts? That's very specific, and that happens to be right in our sweet spot. That would cost probably around $120,000 in legal fees. And that looks like it looks like some of the other questions we're getting are relatively specific. We will go ahead and we will respond to those emails. We will respond to those questions by email on an individual basis. So that will do it for our presentation this afternoon. I'd like to thank you all very much for taking the time out this afternoon and joining us. And if you would like to speak with me and Donna about any corporate matter or transaction, our contact information is on the last slide. And we'd certainly love to hear from you and love to help in any way that we can. So thanks again.
You will receive a follow-up email in the next 24 hours with a copy of the slides and the link to the recorded session. And please feel free to share. Thank you very much.